Hi, and welcome to this edition of the Options Learning Center. My name is Rick Orford, and I've been a stock and options trader since 1999. And today, I'm excited to discuss the long put calendar spread and how to use bar chart to get the most out of the strategy. A long put calendar spread is an option strategy that involves selling a put option that expires near term while simultaneously buying another put option with a longer expiration date on the same underlying asset and the same strike price. The trade results in a net debit to initiate the trade. The goal of a long put calendar is to profit from the difference in volatility of both options while relying on theta decay to render the short put worthless. Theta is an options Greek that tells us how much the options premium will lose each given day, all things being equal. The strategy aims to profit from low volatility on the short option and increasing volatility on the long option. By collecting a premium on the short put with the shorter expiration, it offsets the cost of the long put with the longer expiration. As a result, long put calendar spreads are much more capital efficient than buying a longer date put option alone. Traders often use long put calendar spreads when near term historical volatility, or HV, is low, with the expectation that implied volatility, or IV, will increase as the trade approaches the short put's expiration date. The logic is that the long put's premium increases with the increased volatility. Long put calendar spreads can be at the money or out of the money, depending on your trade preferences and risk tolerance. Out of the money calendar spreads are less risky, have lower starting costs, but they offer a lower profit potential. On the other hand, at the money long put calendar spreads are more expensive and have a higher profit potential, but they're also more sensitive to Vega. Now, Vega tells us how much the options premium might change with a 1% change in volatility. So, this is an essential options Greek to know when trading calendar spreads. The maximum profit of a long put calendar spread happens when the underlying asset's price trades at exactly the strike at the time of the short put's expiration. If that happens, the short put expires worthless while the long put becomes more valuable. The net debit that's paid at the start of the trade is the strategy's maximum loss. This happens if the underlying asset trades significantly above or below the strike at expiration. The specific price for the maximum loss condition depends on the option premiums at the short put's expiration. The trade reaches its theoretical maximum loss when the short put's premium is equal to that of the long put's premium, which renders the entire spread worthless. The break-even prices of a long put calendar spread can be found on the upside and downside, but vary depending on the value of the spread, which changes as time goes on. Break-even prices are also affected by implied volatility, making it a challenge to predict since most of the trade's value is derived from extrinsic and therefore variable value. Long put calendar spreads are complex strategies, and figuring out the details for yourself might take a lot of time. Thankfully, bar charts got you covered with its option screener feature, and let me show you how. First off, head on over to barchart.com if you're not already there. Then, look to the top navigation pane, click on Options, then Long Put Calendar Spread. Once you click on that, you'll be brought to the results page with some long put calendar spread trades that you could potentially buy. You can also rearrange the results page from highest to lowest or vice versa according to any of the column headers you see here just by clicking on them. Now, while these default results are an excellent starting point, you may want to further refine the search. So, To customize your trades, you can click on Set Filters here at the top of the results window, and you'll be brought to the screener page. Here, you'll find all our default filters, and you can add or remove any as you like. To add a filter, just click on the Add a Filter field, and then type in whatever you need. Let's say I want only large mega cap companies in my results. So I can type in market cap here, hit add, and then I'll click on mega. Other filters include your options trading data, like the Greeks, price changes, moneyness, and more. Plus, you also have access to filters for the underlying assets themselves, including technical and fundamental analysis information, trading prices, percent changes, dividend information, and more. Everything you need to fine tune your trading experience is right here at your fingertips. Next up, I'll change the days to expiration or DTE of the first trade leg, which is your short put, to 60 days and below. Then I'll change the DTE for the second leg or the long put to between 60 and 100 days. And now I'll click on See Results. The results are sorted by highest to lowest IV skew by default. IV skew is the difference between the short and long put's individual implied volatility. A positive IV skew is preferable, as that means the short-term option has higher implied volatility than the long-term option. This is ideal because the short put, which you'll be selling, will be priced higher than the other short puts due to elevated IV, which means you pay less for the trade. You can also have Barchart automatically screen the market for the same filters and email you the results every day. To do that, hit the Save Screener button, give it a name, then select when you'd like to get the emails. Okay, so let's take this trade here as an example. According to the screener, you can trade a long put calendar spread on NVIDIA with the stock currently trading at $134.43. The strike price for both puts will be $130. The short put expires on March 7th, which is 13 days from the date of the screen, while the long put expires 83 days from now on May 16th. You'll get $5.10 for the short put and pay $11.35 for the long put, bringing the total net debit to $6.25. Now, let's break this trade down. Let's say, for example, that NVIDIA trades at $130 on the expiration of the short put. This means that the short put has no intrinsic or extrinsic value and will expire worthless. Meanwhile, the long put is also at the money and has time value left over. Traders will be willing to pay for it. So let's say that your long put is now worth $15. If you sell it to close out the trade, your profit works out to $875 per contract, which is calculated by subtracting the initial net debit of $6.25 from the current premium of $15, resulting in an $8.75 per share profit, or $875 per contract. Now, let's see what might happen in a loss scenario. If NVIDIA trades significantly above or below the strike price, the trade will hit its maximum loss. This is because the option premiums will become equal, and when that happens, the net premium of both options will become zero. The maximum loss for the trade is limited to the net debit paid. However, the exact price where the maximum loss occurs depends on the premiums and implied volatility. But let's assume that the stock trades below the strike, at say $100, before the expiration of the short put. This means that both options are deep in the money, and you'll want to close them out to avoid assignment on the short put. So that's screening the entire market for potential long put calendar trades. But what if you have a specific stock or ETF in mind? Well, that's also easy, and I can show you how. First, let's go to barchart.com and then search for the asset by typing it in here in the search bar. Once you're on the stock's profile page, navigate to the left-hand side and look for and then click on horizontal spreads. And then click on the long put calendar tab and you'll see the trade search results. You can filter using the strike price, change the expiration date in the dropdown, rearrange the columns, or you can click the screen button and then the Set Filter tab to access the options screener page for a more granular search. It's that easy. It's always a good idea to close your short positions if they're in the money right before expiration. This is similar to using any strategy that requires selling options. For the long put calendar spread, you do have one active short position, and that's your short put. If that short put does get assigned, you'll be obligated to buy 100 shares of the underlying asset for every contract you wrote. And that likely means that you'll be paying more for the asset than it's currently worth. And closing that position at that time will lead to losses. If you don't want these shares, you can sell them back to the market or assign your long position. Before assigning your long put, however, take a look at the long put premium, as the long put may still have some extrinsic value baked in, so it may be better off selling it than exercising it. So it'll depend on how much time to expiry remains and whether the trading fees cost more than the option premium. Long put calendars have a limited risk profile, meaning you know what you're getting into before the trade starts. Trading a put calendar spread allows you to buy a long-term put at a discount, and it significantly benefits from time decay or theta and volatility expansion as the long put becomes more valuable when volatility rises. Lastly, it's a flexible strategy that allows you to roll, close, or turn your position into something else if the situation calls for it. On the other hand, long put calendar spreads have limited profit potential, especially compared with a long put alone. It also requires low volatility at the entry, as the higher the volatility is at the start, the more risky the trade is in the end. It can also be difficult to achieve maximum profit, as you'll need to be precise with your forecasting. And finally, as with any trade that involves selling options, you're at risk of assignment. The long put calendar spread is best used during low volatility and benefits from increasing volatility and theta. However, it's also a complex strategy and requires precise price forecasting to achieve maximum profit. That's why using any and all resources, including option screeners, will help you get the most out of your trade. If you need more information, visit the Options Learning Center, where you can find out more about long put calendars and also find other options trading strategies, each broken down into their working parts.